Welcome to the deep dive. We're here to sift through those dense quarterly reports and calls, aiming to give you the key insights fast and clear. Today, we're digging into Packaging Corporation of America, PKG, and their Q3 2025 earnings. Now, PKG, they're one of those companies, maybe you don't know the name, but their products are everywhere every day. We're talking cardboard, yes, but it's more fundamental. It's about logistics costs, the box that brings you, everything from online orders to groceries. So looking at the Q3 headlines, it's a bit of a mixed bag, is it? Revenue actually beat expectations, came in at $2.31 billion. Expected was $2.29 billion, so good news there. But then earnings per share, that missed, $2.73 is reported versus the $2.83 analysts expected. That immediately makes you ask, right? Selling more but making less profit per share. What's going on?
Yeah, that mix, it really signals a company in transition. I mean, this quarter is just completely overshadowed by one huge event. That's the Greif containerboard business acquisition they just closed. They got the scale they wanted, sure, but the cost to get in, the integration, well, that definitely hit the bottom line hard. So our deep dive really has to unpack that. Look at the short-term sort of turbulence versus the long-term strategic payoff. They clearly chose to take a financial hit now for a really aggressive immediate fix.
Okay, let's try and unpack that. Maybe start with the original PKG business. If we kind of strip out the acquisition impact, the special items, their legacy earnings actually went up year over year by 0.19 cents per share. That seems, well, pretty healthy for the core operation.
Oh, it's fantastic organic performance, absolutely. And the main driver, simple pricing power. Higher prices and a better product mix in packaging added a massive 0.73 cents per share. That says a lot about demand and, their ability to pass on costs. Plus, they got some help on the input side. Lower fiber costs kicked in another $0.16 per share.
Right, those are really strong tailwinds, almost $1 per share combined upside.
Yeah.
But here's where the other side of the story bites. The inflation battle everyone's fighting. Those gains got chewed up pretty significantly by higher operating costs. That was a 33 cents per share reduction, a big chunk.
And then you had higher depreciation took off another $1.07, and higher freight also a $1.07 hit.
Exactly. You see that tension clearly,
Yeah.
strong pricing, fighting off these persistent cost hikes. That's the story for the legacy side. But then you overlay the acquisition, and the sheer cost of that just overwhelmed the net organic gain.
Yeah.
Management said it plainly. The overall acquisition impact, just for that 1 month they owned it in Q3, was an 11 cents per share loss. And that's before even considering all the special items.
Okay, so that brings us right to the Greif deal. Closed September 2nd. You mentioned special items hearing the bottom line. $0.22 per share in acquisition-related costs. For listeners maybe not deep in M&A accounting, what's actually in that? It sounds like more than just legal fees. Oh, absolutely. Much more. That $1.22 hit comes mainly from two things. First, the straightforward integration costs IT systems, training, getting processes aligned, that kind of thing. Second, and this is a standard M&A accounting hit, is something called the inventory step-up.
Inventory step-up.
Yeah, think of it like this. PCA buys Greif's inventory. They have to value it at the current market price when they acquire it, which is usually higher than what Greif had it listed for on their books. PCA has to step up that inventory value on their own balance sheet immediately.
Right.
But then, as soon as they sell that inventory they just bought, that higher cost flows through the income statement as cost of goods sold. So it automatically results in lower profit on those initial sales. It's a non-cash charge, mostly, but it makes the earnings look, well, artificially worse right after the deal closes.
Got it. That helps explain that $22 drag rag. And this wasn't a small deal, was it? The preliminary valuation numbers are huge.
Yeah.
Roughly $870 million in property, plant, and equipment. Over $800 million combined in intangibles and goodwill. That's a massive addition.
It is. And adding those assets creates a permanent financial weight, you could say. PKG is forecasting an extra $130 million a year just in depreciation and amortization D&A. Plus, they took on debt for the deal, so that adds about $95 million a year in higher net interest expense.
Wow.
So you're looking at, what, over $225 million in new fixed costs annually just from owning the assets and paying the interest. That $130 million in D&A, that's the real ongoing cost of those physical assets hitting the P&L.
Okay, but what I found really striking was how PCA acted operationally right away. They didn't seem to ease in. They used that first month, September, to just overhaul the acquired mills. Like you said, rip the Band-Aid off. They took an extended 5-week maintenance outage at the Massillon mill. 5 weeks. Finished in early October, called it a complete refurbishment.
Yeah.
Fixing reliability on paper machines, the fiber plant, the power plant, everything. And the bigger Riverville mill also had 2 separate 5-day outages for reliability work, too.
Yeah, this really highlights management's approach. It's Pretty unusual, I'd say, to integrate something this big, this aggressively, right from day one.
But wasn't that incredibly risky? Taking a mill you just bought offline for 5 weeks straight. I mean, couldn't that upset new customers? Cause chaos right when you need to show you know what you're doing.
It was definitely a big risk, no question. But management clearly decided that long-term reliability was more important than hitting immediate production numbers. They must have known Massillon needed serious work. If they'd done it piecemeal, they could have faced months, maybe a whole year of, subpar performance, bad quality runs, extra scrap. That costs you more in the end. By doing the whole refurbishment at once, they took the pain in Q3 and early Q4, sure, but they dramatically sped up the timeline to actually getting those synergies they paid for.
Okay, so short-term pain for long-term gain, essentially.
Exactly, and they're already claiming success. Management said they're already seeing the benefits. The specific example they gave was Massillon's startup after the outage. They saw at least a 50% improvement, just in quality profiles, things like moisture control, basis weight consistency.
50%, that's huge.
It's massive. That kind of quality jump is the bedrock for cutting costs later, less waste, higher speeds, happier customers. It justifies taking that initial financial hit.
Right. Better quality means higher uptime, fewer problems. It all flows through. And that connects directly to the synergy targets, doesn't it? They're aiming for about a $60 million annual run rate after 2 years.
That's the target. About $60 million run rate in synergies, cost savings, maybe some revenue gains too. And they expect to see about $20 million of that run rate kicking in by Q2 of next year.
So relatively quickly then.
Yeah, hitting that $20 million mark by mid-next year would show that the aggressive upfront work is paying off. That synergy number is key to making the whole deal math work.
Okay, let's zoom out a bit. While PKG was doing all this intense integration work, what was the actual market like for their legacy business? Did demand hold up in Q3?
The market felt cautious, but it was definitely stabilizing. If you look at legacy corrugated volumes, they were down 2.7% per day compared to what was a record Q3 last year. So yeah, customers were still ordering carefully. But the really important thing was the trend within the quarter, the sequential improvement.
Okay, what did that look like specifically?
Well, legacy shipments per workday. July started off down about 6% year over year, still pretty weak. But then August tightened up a lot less than 1% down, and September finished less than 2% down.
Ah, okay.
So even though they were up against really tough comparisons from last year's record highs, you can see momentum building through the summer. It suggests maybe that inventory destocking cycle is finally easing up for some sectors.
Interesting. Still, even with that stabilization, management did call out a couple of specific areas that were dragging things down for them.
They did. They specifically pointed to the beef segment. Apparently, cattle herds are at a 70-year low right now.
70 years.
Yeah.
Wow.
Yeah. Fewer cattle means fewer boxes needed for meat packaging. Simple as that. The other weak spot was building materials. That's still soft because housing starts haven't really picked up.
So not just general economic gloom, but specific industry problems hitting key segments for PKG.
Precisely. Targeted weaknesses.
And this must also tie into how they manage inventory now, with the Greif assets added in.
It does. Apparently, the Greif system historically held, relatively more inventory than PCA typically does. So now that it's all part of PCA's larger integrated system, the plan is to bring those inventory levels down over the next couple of quarters. And crucially, they said they'll manage that reduction through production. That means running their most efficient mills harder and maybe dialing back others, optimizing the whole network pretty quickly.
Okay, makes sense. Let's pivot to the outlook then. Q4 guidance. They're guiding to $2.40 per share, and it looks like the biggest headwind they flagged for Q4 is more maintenance. Higher outage expense in the legacy system, right?
That's right. They expect outage costs to be $0.29 per share higher in Q4 than they were in Q3, mostly because of a big scheduled outage at their DeRidder mill. That's a significant quarterly hit just for maintenance.
Yeah, nearly 30 cents.
It's the reality of running these big industrial assets. Maintenance is expensive, and it doesn't always fall evenly through the year. But if we connect this back to the bigger strategic picture, we have to talk about that ongoing issue of operating cost inflation. This is where the conversation shifts from sort of fixing things tactically to a much bigger strategic response.
And management was very, very direct about this, especially energy costs.
Brutally honest, I'd say. The CEO pointed out that electricity rates at some of their plants are up 50 to 75% just in the last year or two.
50 to 75%, that's incredible.
It's staggering. And the key point is they don't think this is going away anytime soon. They mention all the new demand hitting the grid data centers, electrification efforts. It's changing the whole industrial power market fundamentally. They see this as a structural inflation threat, not just a temporary spike.
Okay, so if energy costs are this huge, persistent headwind, what's PKG's big strategic answer? What are they actually doing about it long term?
They're responding with some major capital investment, big high-return energy projects. They're planning to use gas turbine technology, essentially building their own power generation to make 3 more of their mills essentially electricity independent.
Electricity independent, wow.
Yeah, within the next 2.5 years, it's a clear strategic bet.
Yeah,
Take one of their biggest, most volatile costs largely out of the equation.
that sounds expensive. Is CapEx going way up?
Well, it's a significant investment, yes. But interestingly, they revised their total CapEx forecast down slightly for this year to $800 million. Mostly just timing shifts, they said. And they expect total capital spending to stay relatively flat in the coming years. But here's the key. They're shifting where that money goes. Less spending on building major new box plants because the Greif acquisition gave them that scale, and more spending directed towards these energy independence projects.
Shifting the focus of the spending.
Exactly. And they stress these aren't just any project, they're incredibly high return. Management specifically described them as one-year payback type project.
One-year payback on major energy infrastructure.
That's what they said. If you can genuinely get your capital back that quickly, it dramatically lowers the risk, right? And you start locking in those cost savings against inflation almost immediately. It's a very aggressive financial hurdle.
Okay, so that aggressive move on energy independence, plus the aggressive integration of Greif, that really seems to capture the essence of PKG right now. Let me try to sum up the tension here for you, the listener. PKG is working through a huge acquisition. There are definite costs hitting them right now, operationally and financially, but management seems really confident that hitting the integration hard and fast will unlock those promised synergies. And, maybe even more importantly, they're making this big strategic pivot towards energy self-sufficiency as a way to fight what they see as permanent cost inflation hitting the whole sector.
Right. Which leads to, I think, a really important question for you to think about. PKG is openly saying, look, electricity costs are a massive structural problem. They're not hiding from it. So by making this ambitious high-return bet to take several mills basically off the grid, could that strategy become their single most important competitive advantage over the next, say, 3 years? Will it allow them to significantly undercut competitors who are still fully exposed to those soaring utility rates? Is energy independence the new battleground?
That is a great question. In this high-cost world, maybe controlling your own energy is the ultimate edge. That CapEx shift could be the defining move for them this decade. Well, that brings us to the end of this deep dive into Packaging Corporation of America's Q3. Thanks for joining us. Stay curious, and we'll catch you on the next one.